On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. Hey team, how are you all going? Episode 250, isn't that wild? I can't believe I've recorded 250 of these episodes and it's only ever me talking. I feel like I'm talking to myself a lot of the time. Can't believe you guys all keep tuning in, but thanks anyway. Hopefully 250 more will fly by just like these first 250 have. Other piece of housekeeping I wanted to mention, I know that I have asked for questions and comments and a lot of you have sent them in. Thank you. I do take note of them. I do read them all and then I put them to one side and think I will address that in due course. So you haven't been forgotten. Some of the questions are really good and I will turn them into their own article and address that point and record a podcast episode along with that. Others, I'll sort of put them all together at some point and we'll do a session where we just run through 5 questions, 10 questions, quick fire or something like that. So please don't think that I asked for them. You sent them in and then I've ignored them all. I'm just sitting on them and biding my time, but they will get a look in at some point. Right, let's look back at last week and everything that happened, or a smidgen of it, because there's so much going on. I certainly won't be able to cover it all. At the moment, things are really busy out there. Then we will turn our attention to the week ahead and what is coming up. So starting with returns and global markets, a bit of a volatile week. The S&P 500 in the US was down 3.1% last week. That's actually the biggest weekly fall since September last year. So that S&P 500 index is down 6.1% from its all-time high, which came last month in February, and the tech-heavy NASDAQ, which is a bit more high-octane, is 9.8% below its record high, which came in December last year. So that is a material fall from the peak, but at the same time, you've got to put things in perspective. Remember, the US market has been up more than 50% over the last couple of years. So it rose 25% in 2023, then it rose another 25% in 2024. So to rise by that degree in a fairly short space of time, then to come down sort of 5-10% isn't the end of the world, but it does feel risky out there, and I appreciate that there will be some nervous new investors. So always a good time to touch base with your advisor, talk to them. They will be able to give you all the strategies and the ways to cope with a period like this, and they might even be able to point you to a few opportunities to make money as a result of it, because that is the silver lining from when you see these volatile periods. It does throw up some really interesting opportunities as some parts of the market get sold off more than they deserve to, so it's a good time to be a buyer. Right, other markets around the world didn't fall as much as that. The US was one of the weakest. The UK and Europe held up much better. They were down 1.5% and 0.2% respectively. So Europe's actually been going very well. That market is still up 10.5% this year before you account for currency movements. Once you do account for currency movements, because the euro currency has been strong too, European shares are up more than 13% this year. So it's certainly not all bad out there. There are some parts of the world that are going very well. Japan and emerging market equities also bucked the trend last week. They were strong. Japan was up 1%, emerging markets up 2.9%. Closer to home, we were sort of in the middle, not quite as bad as the US, but certainly not as strong as emerging markets or Japan. So the Australian market was down 2.7%. That's actually quite a tough week for the ASX 200, and the local NZX 50 index was down 1.6% last week. Interest rates, little moved really, although they have been volatile over the last month or so. The US 10-year Treasury yield finished the week slightly higher at 4.3%, although it is well down from where it's been for much of this year. And locally here in New Zealand, interest rates little moved. The 5-year swap rate ended the week at 3.7%. Right, so let's look back at some of the key releases, and Germany was very much in the spotlight. I won't talk too much about Germany because I am planning on writing and recording something about Europe over the next few days, so keep an eye out for that one for further thoughts. But we got some big fiscal news out of Germany last week. The leaders of some of the reigning parties agreed to approve some big changes to the debt brake before the end of their outgoing parliament. The debt brake is sort of their self-imposed debt limit. So there's a 500 billion euro special purpose vehicle for infrastructure. There's an exemption from the debt brake for defence spending above 1% of GDP, and there's an increase in the net borrowing cap for federal states. So put all of those things together and the purse strings have been loosened. And so while changes were expected, people didn't expect them to be quite as dramatic as that, especially when it comes to defence spending. So you did see quite a big market reaction. Lots of defence stocks were up. We saw the yield on German 10-year bonds rise by the most we've ever seen in a single day. That's in data going back to 1990. We saw the German DAX index, that's the share market index, post its biggest daily gain in more than 2 years. And the euro currency hit a 4-month high against the US dollar. So Germany has been very much in the spotlight over the last little while. Right, turning to some of the other data releases we had, and in the US, a highlight last week were the ISM indices, and probably not fantastic news here. To be honest, they looked a little bit stagflationary because growth didn't look great, but you did see some pressure coming through in terms of inflation, and that is not the sort of combination that you want to see continue. So I hope the politicians and the policymakers are watching these sorts of indicators closely because they don't spell good things for the economy if they do continue. The ISM manufacturing index was above the break-even 50 level again, so that's good news. However, the new orders and employment measures slipped back and the manufacturing prices paid index rose further. So that tells us that inflation pressures are rising. That's actually sitting at the highest level since 2022. So I think those tariffs are indeed pushing price pressures back up again, and that's something we need to keep an eye on. Turning to the services ISM, that strengthened, so that looked good. It was ahead of forecasts. However, the prices paid measure for the services sector also rose more than expected. So we definitely got to keep an eye on those sorts of things. The jobs report, that was also out last week for February, and this was another highlight in the US. Weaker than expected, 151,000 new jobs created for the month. That was below forecasts, and we saw the January figures revised lower too. The unemployment rate rose slightly, came up to 4.1. People expected it to stay unchanged at 4.0. But the thing that really got my attention in this release was the rise in the underemployment rate. That is a broader measure of labour market slack. That was at 7.5% in January, and it jumped to 8% in February. So quite a big jump. And outside of the COVID period, which doesn't really count because we sort of closed the economy down full stop, outside of the COVID period, that's the biggest monthly jump since 2009. And it's actually at the highest level that we've seen in more than 3 years. So this and a string of other weaker economic indicators have seen expectations for more rate cuts from the Federal Reserve rise, and markets now see the Fed cutting 3 times this year, with the next move likely in June. So if you're looking for silver linings from some of the weakness that you're seeing across the market and across some of these key activity indicators, it would be that the door is now open again for the Fed to start reducing interest rates further. So if they were to do that, that would shore up confidence and it would support the economy and it would support markets. So maybe there is a bit of give and take here. Turning to Europe, again, we did see a rate cut last week. The European Central Bank cut interest rates for the 6th time this cycle, took it from 2.75 to 2.5%. It peaked at 4% last year. Now they're down at 2.5. That's obviously come on the back of good progress on inflation. However, I think the ECB will now be keeping a close eye on trade as these tariffs loom, and you've also got those spending initiatives on defence and infrastructure. That could boost growth, which is good, but it could also mean that inflation pressures rise again. So I think that was probably the last easy rate cut from the ECB. People are still expecting more cuts from here, and markets see the policy rate falling to 2% over the second half of this year, so it's 2.5% now. But I think the next few decisions could be kind of a bit more balanced. The next one is in April, and it could be a case of, well, we don't need to move as quickly, let's just pause and do it next time. So we've seen that string of cuts in Europe, and I think from here they will move a little bit more slowly as they're getting closer to that 2%, where people expect the policy rate to settle at. Here in New Zealand, we had some dairy price figures. Prices slipped in the latest auction, so the headline GDT index fell 0.5%. Whole milk powder was 2.2% lower. That was the second decline in a row, but prices are still up in terms of the headline index at least. Prices still up 2.5% this year, close to levels we haven't seen since mid-2022, so, 2.5, 3 years ago. So I think that payout of $10 from Fonterra does look to be locked in for this season, but we will watch that space. Oh, and the other piece of news was that Adrian Orr resigned. The Reserve Bank governor announced his resignation last Wednesday. He will finish at the end of this month, although Deputy Governor Christian Hawkesby will be acting governor until 31 March before the Minister of Finance will appoint a temporary governor for a period of up to 6 months, and then they'll look for a more permanent replacement. So that took markets by surprise, but it's unlikely to change the policy outlook. The next RBNZ decision is due early April. I think the OCR will fall by 0.25% at that time. That'll take it to 3.5%. After that, 2 further cuts of the same magnitude are expected, so that would see the OCR bottom out at about 3% by the end of this year. Lots of talk about Adrian Orr and whether he's done a good job during his tenure. Do I want to go there? Oh, yeah. Look, he's been okay. I wouldn't say I'm his biggest fan. He was a bit prickly at times. He did sometimes seem a bit grumpy and emotional, so I didn't always like the way that he conducted himself or engaged with the market, or chose not to engage with the market. But just thinking about the actual decisions they made, they are quite structured, and there is a lot of committees and so forth. So I don't think anyone else would have really done things particularly differently. Yeah, in hindsight, they cut interest rates way too low and there was too much stimulus, and that created an asset bubble, particularly in the housing market. Did they miss that rise in inflation and were too slow to rein it in? Yep. But same with every other central bank around the world. We were one of the first to start raising the OCR and to start reining in that money printing, and I think we did that in October 2021. Was that the first OCR hike? The Americans didn't do it until sort of March, April the next year, and the Aussies didn't do it until even later than that. So we were definitely one of the first movers at trying to rein it in. And I think you've also got to point the finger at the government when you sort of look back at that period and think we overstimulated, threw the kitchen sink at it, created a housing bubble and a big inflation problem, and then we were forced to essentially create a recession and on purpose create some unemployment to try and fix that situation. But the government spending and the fiscal side of things, that wasn't helpful either. So I think there's more to it than just saying, Mr. Orr could have done a better job. I think he probably did the best that he could with the information he had at hand, and there wouldn't be too many central banks around the world that you'd sort of hold up in lights and say, well, they did it better. But anyway, everyone will have their own opinion, yeah. So we'll watch and we'll wait and see who will be his replacement. Right, turning to this week, and it is another really, really busy week. The highlight, I think, will be the February inflation report in the United States. So this will be out on Wednesday. It will cover the month of February. It will be closely watched, especially after the last release was hotter than expected. So in January, the CPI was up 0.5% for the month. That was above expectations. It was the highest in almost a year and a half, and that saw the annual headline CPI inflation rate push up to 3% for the first time since the middle of last year. So for February, people expect it to come off the boil a little bit. That would be good. Markets expect the headline and the core CPI to both increase at 0.3%, and they expect that headline inflation rate to slip back at an annual level, that is, slip back from 3 to 2.9, so it'd be good to be back in the twos, and that annual core inflation rate is expected to fall back to 3.2% from where it is, I think, 3.3 at the moment. So that's Wednesday night in the US. We'll also be watching the University of Michigan survey. This will be out on Friday night in the US, and this will cover the month of March. It will be really interesting given that backdrop of weaker economic indicators and that combination that we're not really liking the look of softer growth but potentially higher inflation. That's not something that markets like or economies like. So this survey back in February, we did see consumer sentiment fall quite a bit from the previous month, and we saw inflation expectations continue to rise, and longer term inflation expectations actually rose to 3.5%, which is the highest that we've seen since 1995. So that's not what policymakers want to see. Inflation expectations do tend to become a reality, because if we expect something like that as consumers, it will change our behaviour. So this is something that policymakers need to keep a close eye on. So those are the two key releases in the US, one on Wednesday, one on Friday. That won't be all that we're keeping an eye on. Investors will also be watching for progress on the latest funding deal ahead of the March 14 deadline to avoid a government shutdown. And there'll be more on the tariff front. Tariffs are really what's driving markets at the moment, so they will have a big impact on sentiment. And on Monday, China is set to impose tariffs of up to 15% on a range of US imports. And then on Wednesday, the US is set to impose steel and aluminium tariffs of 25% on the EU, the European Union. That's on Wednesday. So watch for more news flow and reaction on the tariff front. Canada also going to be in the spotlight too, with the governing Liberal Party set to announce a replacement for Justin Trudeau in a leadership vote on Sunday. So by Monday morning here in NZ, we might know the outcome of that. Trudeau announced his resignation earlier this year amid sinking popularity. His popularity hasn't been going in the right direction. The frontrunner to replace him is Mark Carney, who you'll know because he was governor of the Bank of Canada from 2008 to 2013, and then he was governor of the Bank of England from 2013 to 2020, and I think he was the first non-Briton to have ever been appointed governor of the Bank of England, and they've been around since the 1600s, so interesting guy. This obviously all happens at a volatile time for Canada with what's happening on the geopolitical front, and there is a general election in Canada coming up later this year. I think they have to hold that by October the 20th. So keep an eye on Canada as well. Oh, and the Bank of Canada also got a policy decision on Wednesday. So markets are expecting an interest rate cut over there on Wednesday from 3% to 2.75%. It's a little bit quieter here in NZ. There's not as much going on. We will have some manufacturing activity figures. We'll have electronic card spending. We'll have migration. We'll have food prices. So all of those things are interesting, but they're not sort of the same level of profile as a Reserve Bank decision or a GDP report or a labour force report or an inflation report. So a few things to keep an eye on, but it will be those global releases and those global developments that do tend to have the most influence on our market, I would think. In terms of corporate news, only Briscoes is on my calendar in terms of results or anything like that. They're releasing their result on Wednesday. Briscoes, great business, always manages to do well against a very difficult backdrop. So I think they're just a very well-run business who manages to succeed even when retailers generally are doing it tough. So keep an eye out for that one. Not much on the calendar across the Tasman, and internationally a couple of things to watch, a handful of results. The most notable one for me will be Adobe. Was on Wednesday in the US, so that will be Thursday here in New Zealand. So again, lots to monitor, lots on the geopolitical front. Enjoy your week, team, and we'll talk again soon.
For more insights, visit craigsip.com.